We are going to do asset protection. Now, this is my disclaimer. Information provided in the seminar is educational purposes only. In other words, don't do a damn thing I tell you to do today. Okay? It does not constitute legal, tax, or financial advice. There's no offer or solicitation or sale of securities or other financial products. Unless you are a client of this firm, no client relationship is established by your attendance. And if you are a client, don't do anything you hear today without talking to me directly. Everything is affected by facts and circumstances. Everybody understand? Everybody good? Give me some thumbs up if you're there. And we are going to take off. So, Joshua already told you, I got 35 years of experience in accounting and tax. 23 years I've been in full-time practice. I founded this company back in 1999. It was a side hustle. And in March of '02, we went full-time. So on March 15th, we will have our 24th anniversary and begin our 25th year in private practice. I am an accredited investor. If you don't know what that is, you either have had, if you're married, $300,000 worth of adjusted gross income for 2 years with the expectation it will continue. If you're single, it drops down to 200,000, or you have $1 million net worth, not including your primary residence. I was one of the first in the nation to be designated MSCTA back in 2023. Some of you may have heard of Mr. Mark Kohler, CPA, JD. He mentors thousands of accountants, CPAs, tax attorneys across the country. This is a certification that was through Mark Kohler. Okay? So, here is a generational wealth principle. You got to protect what you built. Well, who are we going to protect it from? Well, first, there's these cats that want to sue us. We live in, the word is litigious, a litigious society. What does that mean? That means if you haven't been sued yet, just wait, it's coming. People love to pop lawsuits. And who else do we need protection from? Uncle Sam, those that want to tax us. Because let's face it, we've all heard about the waste and the fraud and everything that's been found out. So, yes, we need the military, but in general, I would say that a dollar paid to Uncle Sam has a rate of return of about 0.0% as it pertains to my net worth. So, here we go. What is the first step in asset protection? I'm going to tell you a story. Okay? Here's the story. There was a farmer went to his mailbox and he pulled out a certified letter from an attorney. The adjacent lot had been purchased and surveyed, and it was discovered that his fence was 6 inches onto the other property. And it was a demand to remove his fence within 30 days. He didn't know who the people were that were moving in, hadn't seen them, they hadn't come talk to him. He talks to his attorney and he says, yeah, they got you. You're going to have to move the fence. Well, he moved the fence and then he watched. And when they had their house about 3/4 of the way done, he built a hog parlor, aka a pig pen, right up on the property line next to his fence. They moved in, the hogs moved in, and he fed them a mix that made sure that it created the most awful stench you ever known. Well, he goes to his mailbox and opens it up, and there's a certified letter from their attorney. They didn't come talk to him. They just sent him a letter. And this time he was ready, because when they went to court, the judge told him, you're in an agricultural zone. He has a perfect right on his property to have that hog pen there. So within another couple of months, a for sale sign appeared in the neighbor's yard. Farmer smiles to himself, and one day there's a knock on the door. And the man says, "Excuse me, sir, we were looking at the adjacent property and wondered if I could talk to you a little bit and see if there's anything that we could do about that smell, because we really love the house." Farmer says, "Come on in, let's have a cup of coffee." So the farmer sat down with him, and as the man's leaving, he said, "You let me know the day you close, and I'll take care of that smell." So, what's the purpose of this tale? Be kind, be nice. The first step to asset protection is to treat people well and act ethically, because someone that you have a relationship, they're very less likely to take you to court than someone that you don't know. So go talk to people, shake their hand, develop the relationship. That's part one. What's part two? Insurance. Guys, you don't need insurance until you really need insurance. Okay. So insurance at the property or the business level is extremely important. That might be builder's risk. That might be homeowners. It might be your landlord policy. Might be your general liability policy. Get with a good broker that can advise you on this. And let me tell you, State Farm, Allstate, those guys are what they call captive agents. They can only sell their products. You need an insurance broker. And for your landlord policy, you need something. It's called a loss of income rider. That means when some idiot burns down your house, or they don't tell you about the leak behind the washing machine and your house is eaten up with black mold, that rider is going to give you 12 months of rent to pay your mortgage that just a plain old policy would not. Okay. After insurance, the LLC is your fallback position. If it doesn't go there, we want to stop the issue right there. Now, if it does leak through to you, this is where a personal umbrella policy comes in. 2 to 3 million minimum, depending on the amount of assets you got, and make sure it covers business activities, because not all umbrella policies are created equal. Okay. Part three, LLC 101. Hang on a second. I'm on a webinar. Please do not disturb. Somebody's trying to come in my office. Okay.
They're knocking at your door, Roger.
Yeah, they were. They were. That's like the
Client,
third time, too.
clients always look, people always looking to get your services.
Yeah, yeah. So, most flex LLC, there's corporations, there's other entities out there. The LLC is the most flexible for tax purposes because it can be taxed as anything that we want it to be taxed as. And in some states like Georgia, the LLC actually has better protection. What's Y'all have any idea what the number one way a savvy attorney gets through your corporate veil or your LLC veil? It's called commingling. That means paying personal expenses out of the business. Well, in Georgia, the Limited Liability Company Act specifically says commingling alone will not void your protections. So it's different in every state because it is a state entity. But I like the LLC. Now, once we're done with that, now you're going to make your tax selection. Now, I'm not going to go deep into this, but I'm going to say this. For most people, if you're flipping properties, you're a realtor or you're wholesaling, you need to be an S corp because that's ordinary income. Are there exceptions? Certainly there are exceptions. If you're a landlord, you need to either be in a disregarded entity, that means a pure pass through, okay, that's ignored for tax purposes, or you need to be in a partnership. Hands down. Once again, there's always exceptions, and that's why there's people like me that you can talk to ask the question, can I put my rentals and my flips in the same LLC? No. Number one, you're mixing incomes, but number two, if you get sued, all of your assets are at risk inside of the LLC. Ouch. So I'm asked all the time, where do I set up? You know what? I don't care. You're going to do what makes you sleep better at night. There's all kinds of arguments that Nevada is better or Delaware is better or South Dakota or Wyoming. I've even heard of Montana LLCs. So, bottom line is let's look at some common sense. Common sense ain't so common anymore. I've got people that are starting up that come to me and they've got this grand LLC design and they've spent more money on asset protection, but they don't have any assets. So here's what you got to think about. How much cash flow are you looking to protect? What's the value of the assets that you're protecting? What's the cost benefit? Nevada costs a heck of a lot of money. And Nevada has a big recurring costs. Could you form locally and just insure and get the same goal? These are the things you need to ask. And these are the things you need to remember. No matter where you incorporate, if you work in Georgia and live in Georgia, you're taxed in Georgia. If you work in South Carolina but live in Georgia, you could be taxed in both South Carolina and Georgia, depending on the circumstances. If you live in Georgia but work in Florida, you're taxed in Georgia. Okay, so to me, it makes sense to form in the state that I'm working in and to buy insurance to cover myself. Now, are there legitimate reasons to use an out of state LLC? You better believe there are. And we're going to go over a very specific case of protecting yourself in just a minute. In fact, it's right here. This is one of the reasons you might want to form out of state when you're holding assets. Now, the COPE means is charging order protection entity. Okay. Now, I only use these when we have $750,000 worth of equity in our rental properties. I don't use this for ordinary income activities. Okay. Here's why we use it. Georgia is a foreclosure state. What that means is if you're sued personally and they get a judgment against you and you don't have insurance or you don't have enough insurance, they can foreclose your interest in your LLC and sell off the assets. That's not cool. What a COPE state does is it gives you the ability to have either a partnership or, in the case of Wyoming, Nevada, or Delaware, a single member LLC can be a COPE state or a COPE entity. What it's going to do is if you're sued personally and they get through, they can't foreclose your assets. All they can do is get a lien against the income. That's the difference. Now, there are a lot of states out there, Florida is one of them, Tennessee is one of them, that will give COPE protection to multi-member LLCs. Okay. Now, Roger, I'm married. I put everything on Schedule E. Should I do that? Well, you can, but it would be better if you filed as a partnership. Well, why? Do you like to be audited? Partnership return has the lowest audit frequency in the entire system. So it's a protection move. Okay. How many LLCs do you need? This depends. I got a great video on it over at our YouTube channel, and it's uniquely called How Many LLCs Do I Need? What we have to look at is what kind of income do we have? Is it ordinary income or is it passive income? Am I in a partnership with somebody I'm not married to that's flowing back to my S corporation? How many properties do I have? How many properties can I have in each LLC? I had a guy that came in, he had $2 million worth of property in one Georgia LLC. I about swallowed my teeth when I saw that because he was one lawsuit away from bankruptcy. That's uncool.
Wow.
So then there's multiple entity strategies. At the very end, I'm going to show you a diagram and I'm going to go through my common sense approach and show you how all of this stuff lays out. And not only are we going to include the LLCs, we're going to include the trusts.
Yeah, and Roger, real quick, just in the chat, Ryan, thank you for putting there. It just put a link to our YouTube channel. If you're not familiar with it, you can click on there, and there's a whole library of great quality, informative videos there to check out later. Thanks, Roger.
All right. Now, were there any questions from that section since that was the first major section? And if there weren't, that'll be the first time I've ever done that with no questions.
A little better every time.
All right. Nothing? We'll continue. Generational wealth principle. Never give up control. Well, what do you mean? The trust can control things from the grave. See, I love trust because you can have provisions in them. Let's say that I really want to be strict. In my trust, I can have a provision. Okay, anybody, if you go to jail, you are disinherited. If you use drugs, I'll pay for rehab one time, then you're disinherited. If you challenge my trust, you and your entire family line are disinherited. You can have X amount of money for marriage, for starting a business, for joining the military, or you can have X amount at this age or this age. I can specify the houses to be sold and the assets distributed or the assets invested. This enforces my desires way beyond the grave. Okay, so let's get into the nitty gritty. I'm going to tell you this. You've probably heard a lot of things about trusts. And some people will show up at RIA meetings and they'll say, for $19,999, I'll guarantee you never pay tax again. Run far, run fast. Because if there's income, somebody pays taxes. That is a scam. Okay. What's a trust? Well, there's the legal definition. You guys can read it. Basically, I'm putting this into administration of a third party, the trustee, for me, the beneficiary. Why? The number one reason is to avoid probate. Guys, I've had people that have inherited $50 million worth of commercial property and they haven't been able to touch it for over a year, sometimes 3 years,
Wow.
because it's in probate. And when they wanted to spend any money whatsoever, they had to poke up a hand and ask the
Mhm.
tax court.
Wow.
We control the way assets are distributed, like I was just talking about with these provisions. Now, one reason we may want to provide for minors or for any child with special needs. It's called a special needs trust. Okay. We want to reduce our estate taxes. That's a way around it if we're above the exemption. And we want to get some asset protection. Certain types of trusts do provide asset protection. What can be placed in a trust? Well, more like what can't be placed in a trust. Real estate, your banking, your brokerage, your business interests. The one thing you don't put in there is your retirement. Okay, because retirement, it's already a trust. So pretty much anything. Now, there's two main kinds of trust. Okay, and they are very, very different. First is the revocable. In my opinion, everybody needs a revocable trust because this is how we avoid probate. Okay. It's disregarded for tax purposes. So we put assets into the trust. We make money with those assets, but all of the taxes flow through the trust directly to our 1040. There's no gift tax when we transfer. So if I wanted to put my house into the trust, normally, if it was a irrevocable trust, there would be a gift tax. Now I can get around it, of course, but this way in a revocable, no gift tax. Stepped up basis. Stepped up basis is a key planning item for generational wealth. There is a stepped up basis in the revocable. Now, what does that mean? If I bought a house for $500,000, I pass away, my children inherit the house, and it's currently worth $1 million. They get a step up in basis to the current fair market value of $1 million. So they can sell the house and have no capital gain. Or if they decided to rent the house, they could begin renting and begin depreciating, including cost segregation, at the $1 million, the stepped up basis. If the house they inherited was already a rental property that I had claimed depreciation on, the depreciation goes away. It resets to zero. Depreciation does not survive the owner's death. Okay. If I had 1031 into that property and say I had done several 1031s, all the deferred capital gains go away under the stepped up basis rule. Now, revocables, because I can change anything and take assets in and out at will, there's no asset protection whatsoever. And some of you may have already used a revocable trust, such as a revocable living trust or a land trust. There is no asset protection in a land trust because it is revocable, no matter what some shyster tells you. Okay? It can be changed anytime during our lifetime. Again, everybody that has any assets whatsoever needs a revocable living trust. Now, let's talk about the irrevocable trust. If I put my house into an irrevocable trust, it will create gift tax, but I can get around it by using what's called my lifetime exemption, which I believe is currently around $18 million. If it earns money that does not pass through to me as the beneficiary, then that money will be taxed at the trust tax rates. And the 37% rate starts about $14,000. That's not good. Okay. Look at this third block. There is no stepped up basis in an irrevocable trust. This is for asset protection. This insulates you from your creditors. And once again, this cannot be changed. It is irrevocable. An example is a spendthrift trust or a special needs trust. Okay. Now, there's a third type of trust. Wouldn't it be nice? Go ahead, Joshua. Did you have a
Yeah, I was just going to say I had a question. Maybe you're going to touch on this in a minute, but Justin asked, can we use the gift strategy to a parent in connection with our revocable trust, like deed it into a life estate with the remainder interest in the trust, or do we need the parent to establish a trust and us as the beneficiary, then coming back to us?
establish? Okay, the way you do this is you have the parents establish the trust.
Okay.
Parents would put the property into trust with the children as the beneficiary.
Okay.
Okay. So the way my revocable trust is set up, if I die, nothing happens. Shelly gets everything.
hmm
If Shelly dies, I get everything. If we're both in a car crash and we both go, the trust activates and then our wills are carried out.
hmm
In fact, I just said the word will. Let's talk about a proper estate plan. A proper estate plan has at least three things to it. A will, you know what it says? I leave everything to my trust. Or you can have a type of will that is called a pour over will. And the whole idea is it directs all assets at death into the trust immediately. Okay.
Nice.
The trust is there during your lifetime. The second thing is obviously the trust itself. So a will, a revocable living trust. And there's a third thing. If you're in Georgia, it's called a advanced medical directive, an advanced directive that can speak for you when you can't speak. In some states, it's called medical power of attorney. There's all kinds of different names for it. Those are the three basics. I mean, it would shock you how many million-dollar positions don't even have a will.
Mm,
Or if they do have a will, they've never heard of a trust. Okay. Let's talk about the third kind of trust. Let's have the best of both worlds. This is a hybrid trust. The estate planners have used them for years. Okay. So this is a grantor trust during your lifetime, but it is also irrevocable. So once you set it up, you can't change it. But for tax purposes, it is a pass through while you're alive. Okay. It's irrevocable, but your heirs get a step up in the basis of the assets that are inside it. There is no gift tax when you transfer assets to it because it's a grantor trust.
mm,
Okay. So it gives you the best of both worlds. The thing is, you can't change it. So let's say that you're in a high risk profession where you have a high chance of getting sued. What's a good way to offload assets that you're going to keep? Hybrid trust, put your primary residence in it, put your stock accounts in it. Okay. It will continue to grow. The income will flow through to you during your lifetime. And at death, it becomes irrevocable, just like any trust,
mm.
and carries out your wishes. That's a pretty cool way of doing this. It gives you the best of both worlds.
That's very nice.
So, if you just want to avoid probate, all you need is really an RLT. It's a protection strategy. That's a revocable living trust. It's an organizer. Revocable during your lifetime converts to irrevocable on death. Now, don't let don't let friends do their own estate planning. And don't let your parents do their own estate planning because the favorite thing to do is to put the kitties on the title. Well, I'm going to gift you 50% of my house so you can avoid probate. Mom just screwed you over. Here's why. Let's say mom bought the house for $100,000 and she bought it 30 years ago, but now it's worth 500,000. If mom gifts you half the house, she's also gifting you half of her basis or $50,000.
Mm,
Okay. Mom dies. The house is worth 500,000. On mom's side, her basis goes to $250,000. On your side, you didn't die. There's no step up. Your basis is still 50 grand.
mm,
That means your basis is 300. So if you sold the house for 500, you've got a $200,000 capital gain.
mm. Ouch.
Whereas if mom had just put the house in trust and let you inherit, your basis would be 500,000. You sell it for 500,000, no gain.
Mhm,
That is one of the biggest disservices a parent can do to a child.
mm,
Okay. Yesterday, I got an email from a client and she was doing some estate planning. Her husband was recently diagnosed with an issue that his health will deteriorate over the next number of years.
mm,
And she was thinking about, well, if he has to go into long-term care, I need to get all the assets in my name. Ah, but the law says you're married to him, so you're just as responsible for him as you are, as he is. So that's not going to do anything. So we had a conversation about trust. And I referred her to my trust guy that's going to take care of her. In this case, we're going to move the house into a hybrid trust where it has total asset protection. And within 5 years, if husband has to go into a long-term facility, they're protected. They can't get their home or their primary assets. Pretty good trick. And that was just because I knew and she didn't. Don't try to do this by yourself. So if you own real estate in multiple states, you need a trust. If your estate is worth over $1 million, you need a trust. If you've got anything that's going to be probated, you need a trust. If you've got young children or special needs beneficiaries, you need a trust. If you're planning for charitable giving or tax efficiency, trusts are an awesome tool. That's
Mhm.
when you consider a trust. Now I'm going to show you something. This is called a trifecta diagram. This is copyrighted by Mark Kohler, my mentor. I have permission to use it. And what this does is gives us a visual representation of how we do things. Okay. On the left side over here is our ordinary income. On the right side is our assets split between accounts, passive assets, and personal assets. Down here is a trust, and down here is our 1040. And the arrows show us what the flow is. Here's my W-2 job. This could have been created by my S Corp, or I could have an outside employer. I'm funding my retirement accounts, and my W-2 job flows straight down to my 1040. Now, you notice there's no arrow going anywhere because if you're not pulling money out in your retirement accounts, there is no current taxation in the retirement accounts. Down here is my S Corp. Up here are my business activities, sub LLCs. I want one S Corp, only one. I don't want a whole bunch of S Corps running around. And if I'm going to have a partner in this S Corp, I'd better be married to the partner. You do not form an S Corp with someone you're not married to. This is your primary tax planning and protection entity. Okay. If you're going to go into a partnership flipping houses with someone, that's a sub LLC. Your interest will flow to the S Corp. Their interest will flow off of your trifecta. The income from the sub LLCs, and you might have six. I personally have four that flow into the investor's account at the top level. They all flow the income to here. And I have my shares owned by the Revocable Living Trust. They flow to the trust, which is disregarded for tax purposes and flows to my 1040. Okay. Over here, my bank accounts and my stock accounts are in the name of the trust. My real estate. Here is a partnership that I have with my spouse. If I'm single, then this just sits here at the top. Guys, this is a tax return in a bank account. Nothing happens in here. This is a tax return in a bank account. Nothing happens in here. Down below, I have my sub LLCs that actually hold the property. This income all flows up to a partnership return or a single Schedule E. And once again, the ownership of this LLC is actually in the trust and it flows through. My primary residence is in the trust, or maybe it's in a different trust, a hybrid. So I get this off of my financial statement because to qualify to be a accredited investor, you can't have your primary residence as part of your net worth. So what does it matter anyway? So there's the house. It's in a different trust, but it's still a hybrid. Up here, how many LLCs do I need? Well, quite honestly, I've got a top level S Corp. Some people have a top level C Corp. Depends on the circumstances. Then I've got all my business entities, all my business lines down here, segregated. I might have a flipping partnership with Joe Bob Billy. I might have a separate real estate agency that I have. And you know what? I might own a franchise for I don't know, Wild Burns Unlimited, and they all flow down to one S Corp, one W-2, one place of tax planning. Over here, how many LLCs do I have? Well, how many properties you got? No, you don't have to have one property per LLC. And if you want to use land trusts, I got no problem with that. But remember, the land trust is just going to be an anonymity tool. It's not going to give you any asset protection. And if it went into your name before it went into the land trust name, they can still find it. So here we go. How many do I need? If I got one property, I've got one LLC. If I got two properties, I've got two LLCs. Why? Eggs in the basket. If I trip, I break both my eggs and I'm sued. And both of my properties are at risk. So I'm going to separate them. I buy a third one. I'm probably going to do a third LLC. Now, I'm going to make a decision about how much equity I can tolerate in each LLC. And let's say that I can have, $300,000 per LLC. All right. So I've got 100,000 here. I buy another house. Now I've got 200,000 in equity. I buy the fourth house. I'm probably going to put it here and say, bring that up to 300,000. I got a 200,000. I did a big down payment. All right. Now I need a third LLC. I'll have that third LLC and the next two will go, and I will keep populating until we hit 500 or 300. I'll close it. Maybe I can go to 500 now because I got more properties. But when I hit my limit, I consider the LLC closed and I don't put any more in it. And you should never have more than 5 properties per an individual LLC. Okay. Now, the other thing that I'm going to look at is when I get a total equity of $750,000, this entity needs to be a COPE, charging order protective entity. I recommend Wyoming. It's one of the easiest to work with, and they will give charging order protection to single members. Okay. But remember, if this is a partnership with you and a spouse, you can reduce your audit risk. Now, Roger's other rules. I look at equity, but I'm also going to look at risk. A property across the street that a little old lady has lived in for 20 years, and I can eyeball it every day, has a whole lot less risk than a property downtown at Grant Park where my copper is stolen every other week. Okay. The frat house that the client has at the University of Alabama, you better believe it's in an LLC all by itself because of a high risk. If I've got a property that I have no loan against versus a property that I have leveraged, that one that I have no loans going by itself because I'm not going to put it in with something that's leveraged. Okay. Anything 5 doors or more is going by itself. Commercial would usually go by itself because of the way its cash flows. Sometimes short-term rental would go by itself because of the way it cash flows. Okay. But everything here flows down. Everything flows down either to the trust or the 1040. Now, this one was a short one because everybody's been quiet. Okay. If you are new to investors accounting, this is how to book a discovery call. The discovery call is absolutely free. And then if you are a good fit for us and we're a good fit for you, then you can move on to the next levels. Comprehensive tax consult, everybody coming in the door does one of those. The advanced planning consult is reserved for people that have incomes of at least $450,000 or will very quickly reach that income level. To those of you who are already clients, we have an add-on that you can have. People say they want more time with me. The way you get more time with me is through what is called the executive upgrade. That's going to give you 4 quarterly meetings with me. What are we going to do? Well, for most people, we're going to go over their financials. We're going to look at where they are and we're going to do tax planning. For some people, I've had requests to take the first meeting and to teach them how to read their QuickBooks. Another client is wanting me to help them set up child pay, help them set up a family management company, and set up a Section 105 health reimbursement plan. So we can tailor these calls specifically to the client. And oh, by the way, if you're on the executive upgrade, it's like Disney. You get a fast pass, you go straight to the head of the line. You have exclusive access to me and to my calendar. Um, there was something, oh yeah, free email consultation. You got a question, you don't get charged for the email.